Greetings. I'm excited to share an update with you on the capital markets and the economy for the third quarter. The third quarter is one of those classic examples where good news leads to bad performance in both stocks and bonds. And when I say that, the good news was that we saw a lot of good economic indicators. Right now, the Atlanta Federal Reserve is predicting that our third quarter economic growth will come in at 4.9%, which is the highest it's been in many years. So a really good, robust quarter of economic growth. We also see continued low unemployment, sitting at 3.8% right now, and a lot of job openings that are out there. Not the all-time highs, but very close to them. So as we think about those things, we have really tailwinds in our economy in a way that we didn't expect coming into this third quarter, when we thought we might be headed towards a recession or at least a slowdown in the economic growth. So the good economic reports that we've seen have been paired with a higher level of inflation. And this really shouldn't surprise us. When we think back to mid-July, inflation, it seemed, had been tamed. We had that high of 9.1% in the middle of 2022, and it had come down in July to 3%. It wasn't at the level that the Federal Reserve shoots for, which is about 2%, but it was moving in that right direction. Well, what's happened is that it's reversed course over the last couple of months, and that's made the Federal Reserve say, we need to increase interest rates and continue to do so, and we're going to need to keep those interest rates higher for longer. One of the drivers of the higher level of inflation, of course, has been commodity prices. We've seen the price of a barrel of oil go from about $70 a barrel to about $90 a barrel, which is about a 30% increase. So this and other factors have led to an increase in inflation. And again, the Federal Reserve has been forecasting that their interest rates will be higher into next year and higher for longer than anticipated. So as inflation remains higher than the Federal Reserve would like, and they increase interest rates and plan to keep them there at a high level for longer, how has that impacted both stocks and bonds? Well, as you might expect on the bond side of things, higher interest rates means lower bond prices. It's that seesaw effect that we talk about often. As interest rates rise, bond prices drop, and in the third quarter, bonds in the US dropped about 3% in aggregate. Now, the interesting thing is that stocks dropped about the same amount, dropped about 3% in the third quarter. Stocks, we find that the corporate profits won't be quite as strong when the financing costs of a company are higher, but we also see that bonds become more attractive, and some investors will sell their stocks and move over to bonds as a nice entry point if they can get 5% or thereabouts on a 20 or 30-year treasury bond. So in both cases, stocks and bonds down about 3% in that third quarter. If we think about other investments, alternative investments though, some of those held up better and posted positive rates of return, like direct corporate lending that we've talked about, and catastrophe bonds. Both the Swiss Re Catastrophe Bond Index and the Cliffwater Direct Corporate Lending Index were both positive for the third quarter. Again, just bolstering that idea that being able to invest in a variety of different asset classes helps us to diversify, because each one is going to have its day in the sun and each one is going to have its struggles from time to time. With that, I hope that you found this useful and insightful, and if you have any questions, don't hesitate to reach out to us. Look forward to seeing you in the near future.
If you found this episode valuable, share it with a friend and subscribe so that you don't miss the next episode. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.